Everybody, this is Jim Hiles. It's January the 18th. It's Tuesday, so Market Tuesday. Today we're going to look at the markets from last week, give you some insight as to what's going on, and an opportunity to spend most of the weekend here because of the weather, primarily. A little nor'easter came through, but basically spent a lot of the time catching up. I think a lot of people did too. But I had a lot of time to read, and we read a lot about the forecasts and outlook for 2022. And one of the first things that was said was, it's not going to be 2021, meaning we're going to have higher volatility, we're going to have lower rates of return, but still overall positive. So that's kind of what happened in the last couple of weeks. So far, so good in terms of that, but not so much in terms of performance. The markets were off about 1% last week. We have quarterly earnings starting, and there's a lot of concern about the impact of rising inflation and interest rates on stocks. And the valuations are, particularly in the growth area, taking a beating here, because if inflation does come back and potentially sticks around, that's a bigger and bigger problem for profitability of companies, and that's going to hit their stock prices. When you look at labor costs and shortages being the negative factors with inflation, yeah, that's happening. However, everything I've read over the weekend in research is saying that this is more of a temporary kind of thing. Now, it's a pain to live through. And what's temporary? It could be quarters, it could be the rest of the year, but they are saying, the experts out there are saying that this is a demand-driven inflation, and this is actually a very positive thing, not necessarily a negative thing. There's just simply more demand than supply. There's more capital out there chasing fewer goods. We think that people will figure out, in this wonderful economy we live in, a lot of bright people out there looking to make money in different ways. They're going to figure out how to get the goods to the people to fulfill the demand. Retail markets were kind of caught up in the Omicron and the Delta variant still from last year. So we're still getting COVID impact, particularly the retail sector. The Fed is doing what the Fed has been saying they're going to do. They're going to increase rates at some point this year. Could be 2, could be 4. Bottom line is they've been preparing the market, and we are seeing the 10-year Treasury starting to rise. The short-term rates are also starting to rise. It's kind of a two-edged sword, because when you see the 10-year start to fall, that usually means people are not happy with stocks and buying bonds. So it's actually not necessarily always a bad thing. But what we have seen is that growth has lagged value. Value stocks are things like energy companies, which are on fire, quote unquote, right now. And we have financials and some other industrials out there that seem to be the preferred way to go, particularly if inflation is starting to come back, which it is, and higher interest rates. Growth, on the other hand, is what we call a long duration trade. And typically you're going to see negative performance with rising rates on growth, but it doesn't necessarily mean you should bag all your tech stocks. Matter of fact, you probably should keep most of them and stay balanced this year. It's going to be one of those kinds of years. When you look at what's going on with crude oil, it has gone up. We probably, and I think I said this earlier, are looking between, it could go 90, it could go 100. No one knows for sure, but as I said before, supply and demand, generally that means that more oil rigs will come online at these prices, and that generally has an effect on prices at some point. We have a couple of wild cards, what's going on, certainly with Russia and the impact on the Middle Eastern oil, even though we are theoretically net distributors, net exporters now, it still has an impact on crude prices. Dividend stocks are making a comeback here, which is value stocks primarily, which is good because last year they and growth pretty much about tied 50-50. Leaders and laggers, some of those dividend payers are staple stocks, which these charts are relative to the S&P, and staple stocks have not been the place to be, particularly in the last couple of years. And we're seeing a recovery here in staple stock. It's a defensive play, it's often a dividend play, probably better suited for environments that we're coming into in 2022. Material stocks are inflation driven from a supply and demand standpoint as well. So we like material stocks. Real estate's kind of taking a hit. We would expect real estate to turn around, as it tends to be more of an inflationary hedge type of instrument where you can increase rents, for example, on shorter term leases. You can offset the impact of inflation, but utilities themselves continue to lag. It's an area we've just stayed away from. You can look at some of the sectors here that we are looking at in terms of leaders and laggers. We are seeing something interesting in the emerging market area, which we've been waiting to see for literally 2 years, maybe 3. that the emerging markets might actually be responding positively, and you might get some diversification impact, meaning that investments in emerging markets might actually play out to be positive when the US market perhaps stalls here a little bit because it's been on such a growth tear. So that's what's going on right now. I think I'd stick with what you're doing. Your allocations make sense. Check your quarterly reports are coming out this week. We'll probably send another video out next week as well, kind of explaining what's going on. But if you have any questions, let me know. Happy to go through your report, your situation, whatever you like. Jim Hiles signing off for now. Thanks.